that question. So
yes.
I think this revision will help, but I have struggled. In fact, I just tried to upload it in the assignment box, and I'm not able to.
Okay, let me go slowly here. Let me go slowly.
Yes.
Yeah.
So do we create the general journal where we put this?
Yes, we create. I want us to. I am just explaining each and every
statement.
Then I'm going to go and prepare that journal.
Okay.
Okay.
Okay. Thanks.
Karibu. So that is the.
So when do I send my assignment? Sorry, Mwalim. Do I email it to you?
No. You need to send it via the LMS, so that once I grade it, it can actually be captured and as part of your assignment.
The Nini is not, the Dropbox is not open for me to.
It has been actually
upload
right now it cannot, because the time has already expired for uploading, but immediately after the class, maybe you can remind me. I open it maybe for an hour, you submit.
Even not an hour, because I have it ready. It is wrong, but I'll upload so that I can learn.
Okay, no problem. Just remind me. Just remind me. Okay.
Okay, thank you.
So what we are referring here about, I want you to understand how we treat the sales returns. Sales returns, they are debited. Remember, sales is always credited. Don't forget that. But its return, the return for sales is debited, is always on the other side. So you need to understand that it was debited, but now there was an undercast. If it is an undercast and this account is normally debited, then the undercast is on the debit side. Therefore, we need to debit again so that hello, I don't know why it misbehaved, but I hope it is not going to give us stress today. So the explanation I was giving is about the sales returns. Just under that, the same case, if you are told about maybe purchases returns, remember purchases is always debited, but purchases return is normally credited. So the returns are normally the opposite side of the main account. So for the sales is always credited, but its return is normally debited. For purchases is normally debited, but purchases returns, they are normally credited. So once you have understood that, then having this error corrected becomes a bit easy. Number two, a check of 4,000 paid to Ouma, a creditor, had been omitted in his personal account. Remember, a creditor is a person we are supposed to pay because he supplied goods to our business on credit terms. He supplied goods to our business on credit terms. And when we are acquiring those goods, at the point of creating this creditor, that is the point of purchasing, we normally credit their account. When we are buying goods from them on credit, we normally credit the creditor's account. But when we are paying them, we normally debit their account because we are reducing the debt that we had credited their account with. So like, for example, if this creditor Ouma, we were supposed to pay him maybe 10,000, the 10,000 will be on the credit side because we are creating a liability, and when we are creating any liability, we normally credit the liability account. But when now we are paying the liability, we normally debit. So Ouma was supposed to be debited because we are paying, or we are reducing the debt that we had entered on the credit side by 4,000. Having understood now, you are told it had been omitted in his personal account. This one was omitted, or Ouma's account was not recorded with the 4,000. So the omission was in the personal account of Ouma. That is what you need to remember here. The error was not in the bank. The error was in Ouma's account. Instead of debiting that account with 4,000, we made an omission in that particular account. And that account was supposed to be debited because it is a payment to a creditor. So a creditor, when it is being created, when we are buying goods on credit, we credit creditor, but when we are paying the creditor, we debit that creditor. So this one was supposed to be debited. So we debit OMA, and then we credit the other account, which was supposed to be suspense. Number 3, a check of 5,500 received from Kibet had not been entered in the cash book. Most people were not getting it clear. They were recording Kibet, but not here. Where is the mistake? The mistake is that it was not entered in the cash book. That is where the mistake is. The transaction was not entered in the cash book. So with the Kibet, everything is okay. The mistake now, it is in the cash book. When we are receiving a check in the cash book, which is actually cash or bank, when we are receiving a check in the cash book, which is actually cash or bank, it is normally debited because it is money being received. But now the cash book was never debited. The cash book was never debited. That is what this error is talking about. So we debit the cash book, or you can say debit cash or bank, and then we credit the suspense account. There is no mistake in Kibet account. The mistake is only in cash book. The 4th error, repairs to motor vehicles 15,000 were entered in motor vehicles account. Instead of being in the repairs, they were entered in the motor vehicle. This is actually an error of principle, and we don't involve the suspense account. It is a matter of cancelling from the motor vehicle and bringing it to motor vehicle repairs account. And then lastly, which is actually the transaction that many of you are not getting it right, I think apart from one person. And the transaction is reading, rent receivable, 19,000, had been debited in rent payable as 91,000. It has been debited in rent payable as 91,000. The point here is rent receivable, it is a revenue. It is money coming in, or it is a source of getting money as a business. And any source of getting money, it is normally credited. Any source of getting money, that is why actually sales is normally credited, because it's a source of money into the business. So this account was supposed to be credited with 19,000. But look, where was the mistake? The mistake is that it was entered in rent payable on the debit side. As if that is not enough, it was entered by 91,000. So here we have got like 3 or 2 mistakes that we are handling. The transaction was to be entered on the rent receivable. It was entered by mistake in the rent payable. And again, it was entered using a wrong amount. So note here, this account was supposed to be credited by 19,000. So we do that. That one we must do it. Then rent payable was debited by 91,000. Remember here, it was debited by 91,000 by mistake. To remove this wrong debit of 91,000, we shall credit rent payable by 91,000. So we cancel this error. And then now, remember here, we have credited 19,000, we have credited 91,000. So we shall debit by the total of the two. That is 19,000 and 91,000. We debit the suspense account so that we can be able to complete the double entry. So that is how this transaction was supposed to be worked on. Anybody with a question before we go to the journal? Okay, then.
My assumption was
yes,
that the company was to receive 19,000.
Yes.
But had been recorded like rent they were supposed to pay of 91. So I deducted the 19 from the 91.
You got 72?
Yes.
Yes.
So that's the way I did it. And then I 72 in the suspense account. I don't know. I didn't quite understand it.
Okay, you tried actually, it was a step, but now by so doing, you will not have rectified the error. The error will not have been rectified. So So what you need to do, first of all, rent receivable of 19,000 was supposed to be credited, because anytime we receive rent, anytime we receive discount, anytime we receive commission, those accounts are supposed to be credited. So we credit first of all this, then this was debited by mistake. Rent payable was debited by mistake by 91,000. Because it was debited by mistake by 91,000, we credit so that we cancel that error.
Okay.
And then now, because we have credited this and we have credited this account by this, then now we complete the double entry using the suspense account, which now is going to have the sum of this plus this. And then that error will stand solved.
Okay.
Okay. Okay, let us see how it was supposed to be worked on the general journal. So on the general journal, this was supposed to be the case. We were supposed to have a column for having the serial number. So there's no need of date here, sorry, number. And then we have the details. And then we have the debit and the credit columns. Sorry. Let me just go direct to number one. Number one error. It was about the sales return was undercasted by 1,600. Sales return was undercasted by 1,600, and we have agreed sales return was supposed to be debited. And if it was debited by less 1,600, we debit again. So we debit the sales returns by 1,600. Let me draw this line. And then we credit the suspense by 1,600. Note this, sales returns is normally don't credited. Many of you are putting it on the credit side. It was supposed to be debited. Unless it was an overcast, that's why we could have indicated on the credit side. Number two, it was it a check that was paid to Ouma? There's a check that we had paid to Ouma, which was missing in his personal account. A check that was paid to Ouma, a creditor, was omitted from his personal account. Remember, I've said here, anytime we are paying a creditor, we normally debit that creditor. And if we paid the creditor and we did not debit the creditor, then we need to do so. We debit Ouma because he was never debited by 4,000. Then we credit the suspense by 4,000. Number three, it was a check that was received from Quebec of 5,500, which was missing in the cash book, in the cash book. Once we receive a check, it was supposed to be entered on the debit side or the receipt side of the cash book. So you can come here and you say, we debit the cash book, or you can say the bank, because it was a check of 5,500, then we credit the suspense by 5,500. Number four, the motor vehicle repairs were entered on the motor vehicles account. Both accounts are supposed to be debited, but now we debited a wrong account. Motor vehicles is not supposed to be debited by the repairs, because repairs is actually an expense. So we need to debit the repairs account by 15,000. And because motor vehicle was debited by mistake, we credit that account so that we can cancel the error. Like that. So this one cancels the amount that was indicated here by mistake, and then this one is placed where it was supposed to be placed. And then number five, where we had a case whereby it was a rent that was received, rent that was received of 19,000 was entered in the rent payable as 91,000 on the debit side. So one thing you should be able to do here, one thing we should be able to do is to let us credit the two accounts. Actually, that amount was supposed to be recorded in the rent receivable. And the rent receivable, it is normally credited. Anytime we receive money from a source of income, we normally credit that source of income, which is 19,000. That was the correct amount. Then rent payable was debited by mistake by 91,000. Because it was debited by mistake, then we should come here. This is rent payable, which is an expense, sorry. Rent payable, which is an expense, it is supposed to be credited by 91,000. The reason as why we are crediting by 91,000, it is because it was debited by mistake. And then the total, the sum between the two, it is now supposed to go to the suspense, which is supposed to be 110,000. You record it in the suspense, which is 110,000, and the journal entries will be done. The journal entries will be done by so doing. And then the question was requiring we open a suspense account. And the suspense account is very easy once you have the journals. So here, suspense account, we have the credit side and the debit side. We need to understand which side was having less. Which side was having less from the statement that we had at the top there before we go to the errors that were witnessed. Can somebody read the question at the top there? There's somewhere that saying maybe the debit side exceeded the credit or the credit exceeded the debit.
Okay. On 31st December 2015,
yes,
the trial balance failed to agree. The debit side exceeded the credit side by 98,000.
So there, the debit side exceeded the
credit side by 98,000, yes.
So the credit side is the one that is having less because the balance is normally indicated on the side that has got less. So the debit side exceeded the credit. So we have the balance brought down of 98,000.
Yes.
And then you come here now. You just locate where we have written suspense. Like here, suspense has been credited. We have credited suspense by 16,000. So we record it on the credit side. So you just come here and record sales returns of 1,600. You record it on the credit side, but you use the name of the other account that were treated or that were corrected together. So in this case, again, you can be able to find suspense here, which is appearing on the credit. So we put it on the credit, but now we use the name of the other account, which is OUMA. 4,000. We come here, suspense account again has been credited. So we write it on the credit side. Then we can write the name of the other account, maybe the bank, which is 5,500. Here, there is no suspense here. So we don't record anything in the suspense account for error number 4. And then for error number 5, suspense account has been debited. This amount is appearing on this debit column. So we debit, but now we debit by rent payable, which was 91,000. And then we have rent receivable of 19,000. We debit, we don't write 110,000. We use these other accounts. So the rent receivable 19,000, rent payable 91,000. And I confirmed this one was not balancing. This account was not balancing. But this is now the correct way of doing that question. This is the correct way of doing the question. I understand maybe it is a tricky area for you. We will be having quite a number of questions more often so that you can be used to it. I will be sending the question maybe on WhatsApp. You try it and maybe you send it back to me via the WhatsApp. I can check and respond on how best you have done that particular question as we move along with the syllabus.
Yes, Mwalimu, like me,
yes.
I think the initial time I had done it well, then you came and spoke about the same question and you touched something to do with suspense,
yes.
being on top when it's debited. So what I just went to interchange everything from what was right to what is wrong.
Oh, well.
I've learned.
Yeah, okay. So you treat each and every error the way it comes. You read the statement, understand where the mistake was, and then you know how to deal with it. Okay. Where most of you also don't understand where we involve suspense account. Suspense account is normally involved in cases where only one account has got a problem. Only one account has got a problem. Like here, it was the sales. Hello.
Yeah, I was asking.
Yes.
How do you determine which side the suspense account? In this case, I put the 98,000 on the debit side.
Okay.
But I see now we are putting the credit side. I think I'm confused there.
Okay, let me explain. For you to understand the side that you are going to indicate this balance, it is actually indicated on the side that has got less. Once the trial balance fails to balance, obviously one side has got more than the other side. The side that has got less, it is where you indicate your balance. Like in this case, it was saying the debit side exceeded the credit side by 98,000. So if you read the statement, it's simply the debit side has got more. So you put it on the side that has got less.
Okay.
Okay.
That's clear now.
Okay. And also point to remember, it is not always on credit. It can be either debit or credit, but it is on the side that has got less amount.
Less.
Okay.
Thanks.
Karibu. Okay. If there is no question, we can now move to the bit that we did not finish properly last time, which was on the control account. I emphasize one or two things. We do one question, and then we should be able to proceed. We should be able to proceed to what we were supposed to cover today. So last week, I introduced the suspense account. Sorry, not the suspense account, but the control account. And I did explain that control accounts are meant to check the accuracy. Just a minute, let me tell somebody here to converse with Rotons. Okay, the control accounts, they are meant to check the accuracy of all the debtors or all the creditors. The accuracy of all the debtors, it is normally checked in a control account we call the sales ledger control account. So the sales ledger control account, it is going to have like a summary of all the debtors in terms of the amount of goods that were sold to them on credit, the discount that was given to them, the amount that they paid, the bad debts that occurred as a result of the credit transaction. All that summary is going to be obtained in the sales ledger control account. Then the creditors, who are actually our suppliers and we owe them money, the accuracy of all those accounts is normally checked by the purchases ledger control account, also known as the creditors control account. So these accounts, they are going to have like a summary. Instead of having individual debtors account, we have the sales ledger control account, which is going to have now a summary of every debtors account. The same case with the purchases ledger account is going to have a summary of all the creditors' individual accounts, so that now we can be able to know whether we have the accurate amount that we need to transfer into the final financial statements, or we need to do some correction of errors if we find there's any. So we talked about the format of each. Maybe I can give a summary of these accounts. So we have got the sales ledger control account, also known as the total debtors control account. We have the credit side and the debit side. The debit side of this account, we said it is used to record those increases or those transactions which increases the debtors. Remember here we are controlling the debtors. Any transaction that we are going to do as a business which is going to increase the debtors, it is normally debited. But we normally start always with the balance brought down. This debit balance, it must be there. You must be given this one. But sometimes you can be given a debit and a credit balance. So you record them the way they are. The balances brought down. This one you record or you pick them from the question paper the way they are. The debit balance, you put it on the debit. The credit balance, you put it on the credit. But if it is only one balance that is given, that balance will always appear on the debit side. It is going to be on the debit side. But if there are two, the one that is going to be of high amount is going to be on the debit, and the other one is going to be on the credit. And I explained why we have these two balances brought down. And I said, in some instances, remember when it is on the debit side, it simply means that these debtors have our amount. They have this amount to pay us as the business. But when we have this amount on the credit, it simply means that it is the business to pay them. It is the business that needs to pay them, either because they paid in excess or they returned some goods after they have paid, and therefore we need to refund them the amount of money. Then on this side, we are going to record items that increases the debtors, items that will increase the amount these debtors or customers are supposed to pay us at the end of the day. And one of them is actually the credit sales. You pick the amount as given, you put it there. We are going to have, what else is going to be found on this side? We talked about the interest, which is sometimes is normally referred as the penalty for the overdue account. If, for example, these debtors, we agreed, maybe they pay us after 1 week and thereafter we shall start charging them interest for delaying, then that penalty will be increasing the amount that they are going to pay us at the end of the day. We also have refund to debtors or customers. The refund is also going to increase. And I explained this point whereby, if, for example, we were expecting a total of 350,000 from all the debtors, but one debtor, we find that he had paid by more. He had paid by more, which is 5,000 more for that case. If from our initial calculation, we had found that we are supposed to receive 350,000, but the moment we find that a customer had overpaid by 5,000, you find that now the amount that we are going to demand from them goes a bit up, because this amount that we were to receive from them, or the expected amount, it is now going to factor. Actually, we had factored that this amount has been received from the debtors, but we found one individual has overpaid. We refund it, but it increases this one. These are the 1, 2, 3. These are the main 3 items that you will never miss in this question. But if they miss, maybe one will miss, but they are commonly found on the debit side. And once the question comes and they are there, you record it on the debit side. Then on the credit side, we are going to have the things like cash received. The moment they pay, actually these are items that are reducing the debtor's amount, the cash we receive from them. It can be the checks received. You record them here. It can be discount that we allowed them. Remember, once you give your customers a discount, it reduces the amount that they are going to pay you. It can be returns, which is the sales returns. If they return some goods, it reduces the debt. And also, what else? We have the bad debt. If you realize that some debtors are not going to pay you, you write that debt off and you don't expect to receive that debt. So it reduces the balance that you expect to receive from them. And having said that, we have the contra. The contra, whereby we said it is a case whereby a particular customer is both a debtor and a creditor. So in one way, the amount that we owe them and the amount that they are supposed to pay us, they cancel out. That contra is going to reduce the amount. And then lastly, we have a dishonored check. Dishonored checks is going to be appearing on this side. Dishonored check. This is a check that was received here, but when you take it to the bank, it gets dishonored. So you increase the debt back. You increase that debt back. That is going to be the sales ledger control account format. Then we can talk about the other control account, which is the purchases ledger control account. The purchases ledger control account, it has the credit and the debit side. You realize that these items that were appearing on this side, on the debit side, they're now going to go on the credit side of the purchases ledger control account. Items that increase the amount of money that we are supposed to pay to creditors. Remember, this one is meant to confirm the creditor's amount. So anything that is going to increase the amount that we are supposed to pay the creditors, it is supposed to be recorded on this side. But first of all, it must start with balance brought down. If you are given to record it on both sides, but this one is going to be higher than this one always. And again here, this one arises through a case whereby some creditors are supposed to refund us some money, either because we paid them in excess, or after clearing their account, we find that some of the items that they gave us, they are not actually good, so we return to them. So we return these goods to them after we have paid. So they need to refund money for the items that have been returned to them, because we had already cleared. And then what will increase the creditor's amount? Number one, it is the credit purchase. You put, if we continue buying on credit, it increases the creditor's amount. Number two, it is actually the penalty or interest. If they charge us interest because we have delayed paying our account, then it is going to increase the amount that we are supposed to pay them. Also, we have the refund to creditors or suppliers, like that. And then if there is a dishonored check, which is going to be very rare, if we have a dishonored check that we give them, if we have a dishonored check that we give the creditors, then we put it on that side. Then on this side, we record items that are going to reduce the creditor's amount. And what is going to reduce the creditor's amount? It is actually cash paid. If we pay them, we are reducing. Checks paid. If we pay them by check, still we are reducing the debt. If we receive a discount from them, this is a discount received, it is reducing the debt. If we also have purchases returns, if we return some goods to them, it is reducing the debt again. Then we have the contra, or also known as the set-off. If some of the creditors are also our debtors, so the amount of money that we'll cancel, we owed them 500, They owe us 500. The 500 cancel out is actually reducing the debt. So these are actually the items that are going to be found on the debit side. So you realize it is only the terms that are changed. Where here we are talking about the cash received, here we are going to talk about cash paid. Checks received, checks paid, discount allowed, discount received, sales returns, purchases returns, but we don't normally have the bad debts for the purchases ledger. And then we have the contra, which is appearing on this side. It is going to appear on the other side. What we have on the debit here goes on the credit on the other side. Here we have the credit sales for purchases. Upande wa credit tutakuwa na credit purchases, interest stroke penalty charged. It is still going to appear there. Refund to customers. There we are going to have refund from customers, from suppliers. Dishonored check is also going to appear there if it arises. And then we are going to finish by having the balance carried down, which is also going to be appearing on both sides like that. But realize this, in the question you will be given the closing balance, but they normally change the position. If it was on the debit side, you bring it on the credit side. If it was on the credit, you put it on the debit. The same case happens here. You finish by having the balance carried down and the balance carried down, so that the two sides are going to have the same totals. And you finish by that. I want us to look at one question so that I can demonstrate that. It is a very easy area. I'm so sure you are not going to have difficulties with it. The questions that I sent today, if you can be able to locate the question that was talking about the following information was extracted from the books of account of contract traders for the month of July 2014. Contract traders for the month of July 2014. Are you able to locate that question? Are you able to locate the question? If you can, the better. Because the question was in hard copy, I cannot be able to share it on the screen.
Okay, we can read Malia.
You have it, eh?
Yes.
Okay, if you have it, then it's okay. You can assist me. Let me open the two accounts so that as you read, we put it appropriately on the account it is. Okay, Susan, now you can start.
The following information was extracted from the books of accounts of contract traders, yes. Contract traders for the month of July 2014.
Yes.
Sales ledger balance 1st July 2014. Debit 725,000. Yes. Credit 64,200.
Okay, let me record that. That is the sales ledger control. Remember, those are the balances 1st July. But when you go at the bottom there, you are told that for the month ended that 1st July. So 1st July, it is the beginning. So those are the balances brought down. With the balances brought down, you record them as given. So for the sales ledger control account, you come here and write balance brought down. On the debit side, you record the debit balance, which is 725,000. Then on the credit, you record the credit balance, which is 64,200. So you write it as balance brought down 64,200 like that. You have recorded the opening balances. Go to next, Susan.
Purchases ledger balances 1st July 2014, debit 30,200 and credit 653,200.
Okay, those are also the opening balances for the purchases ledger control account. So you come here on the debit side, the balance was 3,200. You record it as balance, brought down 3,200. On the credit, the opening balance was
653,200.
Yes, 653,200, like that. Next statement.
We had credit sales of 980,000.
Credit sales will come here on the sales ledger control account, and because it is going to increase the debtors, you record it on the debit side. So you come here and you record the credit sales. It was amounting to 980,000.
Yes.
980,000. So you put it like that. Next.
Then we had credit purchases.
Yes.
440,000.
Credit purchases, it increases the creditor, so it is going to appear on the credit side of the purchases ledger control account. So come here and record credit purchases 440,000.
Yes.
Like that. What about if there was what about if there was cash purchases and cash sales? How will we treat it? Let me respond to it. If we have cash sales and cash purchases, they are never recorded in the control accounts. Control accounts is only meant to control the debtors and creditors. If a transaction was on cash basis, then there was no creditor, there was no debtor, and therefore you just ignore that transaction. It should never be recorded in the control accounts. Kindly note that. Next, Susan.
Interest charged to debtors, 8,000.
Interest charged. Remember, once we charge the interest to our debtors, then we are increasing the amount that they are supposed to pay us. So there is interest here that is amounting to 8,000. It is amounting to 80,000. Next.
Dishonored check from a debtor, 64,000.
Yes, it is going to be here. Dishonored check, because it was actually received. Remember, the checks that are received are recorded here. But once you dishonor it, you increase the amount back because that money is like it has not been received. 64,000. Next.
Discounts received, 38,000.
Discount received is normally for the purchases. Discount received is normally for the purchases, and it is going to be reducing this amount. So we record it here. Discount received amounting to 38,000.
38,000, yes.
Next.
The discount allowed. Discount allowed 30,400.
Discount allowed, we normally allow it to our customer. We normally give it to our customer, so it is going to reduce the amount that we are demanding them for credit sales. So we put it here. Discount allowed, that is amounting to how much?
30,400.
30,400. It is reducing that. Next.
Next is returns inwards.
Return inwards, it is actually the sales return.
17,000.
So it is reducing this amount. So you put it here, return inwards, 17,000.
17,000.
It is next.
Returns outwards.
It is reducing the credit purchases. So we put it on this side. Return outwards. Sorry. It is reducing the credit purchases. How much was it?
12,000.
12,000. Okay. Yes. The next one.
Bad debts written off.
It is now going to affect the sales ledger, and it's actually reducing because it is the debt. Remember what we have here, it is what we expect to receive, the balance. But once we have confirmed that some debtors are not going to pay us, we reduce this balance to the expected amount. So you put it here as a bad at how much?
13,500.
13,500. Then we have next one.
We have cash refunded to debtors.
Cash refunded. Remember that is a refund. Refund
Yes.
to debtors, you increase the sales ledger control account, which was amounting to
6,500.
6,500. Next.
Sales ledger debits transferred to purchases ledger.
That is actually what we call the contra or the set off. So they can use, either they use the word contra, they can use the word set off, or they can use this statement: sales ledger debits transferred to purchases ledger. That is a contra and will appear on both sales ledger control account and the purchases ledger control account, the same amount. So we normally put it here. Let me use the word contra. It is 24,000. Then we also come here and write contra on this side. So it is reducing the purchases and reducing the sales at the same time. Reducing the purchases control, so we need to capture it like that. Next.
Bank receipts from debtors.
Bank receipt from debtors.
1.5.
Those are now the checks received. Let me use the word to bank receipt from debtors, 1.5. Next.
Bank payments to creditors, 960,000.
It is reducing the creditor, so we write here bank payments of 960,000.
960.
Like that. Are we done?
Sales ledger balance.
31st.
31st, yes. Credit 79,000.
That is now the point I was saying. The crossing balance, you must be very careful on the side that you have been told it is credit. Because you have been told it's credit, you record it on the debit. You change the position. If it was debit, write credit. If it was credit, you write debit. So in this case, you are told credit, therefore you put it as debit. And because it is a crossing balance, you write balance carried down. And it is how much? 79? 79,000.
79,000.
The other one?
Purchases ledger balance 31st July, debit 45,000.
If it is debit, you record it on the credit. So you come here and write it as balance carried down. You put it on the credit side, 45,000. Now you are through with the posting. Now what remains is to look for the next balance carried down. You look for the other balance carried down if these accounts are not self-balancing. So you add what you have on this side, you add what you have on this side, you subtract so that you can be able to know which side has more and by how much. Let me balance this one, and then you balance the other one. This one looks more than this side. So can you get the total for the credit side? And actually that is actually supposed to be true. Somebody to add the credit side. This is 653,200 plus 440,000 plus 45,000. $653,200 plus 440,000 plus 45,000. What is the total?
1,138,200.
Thank you. So the two sides, they are supposed to have the same figure. 1,138,200. So what is now the difference? Can you add this 30,200 plus 38,000 plus 12,000 plus 24,000 plus 960,000? 3,200 plus 38,000 plus 12,000 plus 24,000 plus 960,000. What is the total?
1,064,200.
Can you minus from this? So 1,138,200 minus your answer, so that now you can get the next balance carried down.
74,000.
And that sales, that purchases ledger control account is well prepared. You go to the sales ledger control account and you do exactly the same thing. You total, this side is going to have more. You add this side so that you can have your total. You can have the total there, put the same total here, then you add this side, then you subtract from this to get your balance carried down, which is going to be here. And then it is done. I know this one is a bit easy. It does not have much confusion. Is it true, or it is a bit hard?
Mwalimu, you had posted the same question for assignment, I think.
Is it there? The same question, eh?
Yes, for the assignment that the latest assignment. So I only got lost at where? At the refund. The 6,500 is what I interchanged.
The 6,500. 6,500 was a refund.
The one for the refund.
Okay, I see.
Yeah, yes, I had put it on the credit side instead of putting on the debit. And then I also, where we have the balances at that 31st, I picked as is instead of putting on the other side. I posted where they said it's on the credit, I just posted on the credit side. Yeah, but I did the contra well, yeah.
I think now you have noted, eh? Okay.
Yeah.
Okay, I will post a new question then. I will post a new question for your assignment for you to try. It is actually due by Saturday, so try to finish it by Saturday and then you submit. So that is actually
and those of us who had done it, you can mark for us just to know where we are. Like me, I had already submitted.
No problem. I will mark and respond.
Okay, thanks.
So the sales ledger and the purchases ledger control account, there is no any other way you can be tested about apart from what I've just explained. But in some cases, you can only be given the single opening balance. If you are given only one opening balance, you just put it one, and then at the end, you also have one closing balance. There's no major thing that we need to discuss about it. But note what goes to the debit side of the sales ledger control account and what goes to the credit side of the sales ledger control account, and do the same to the other. It becomes easy for you to understand it is actually credit, sales, interest or penalty, dishonored check or refund. And this will actually go to the credit side of the purchases ledger account. But now it is going to be credit purchases, interest charged by the creditors and all that. But they normally change the position like that. So the bad debt, it normally affects the sales ledger control account. So anytime you come across it, you put it on the credit side of this. Okay, that is that. Allow me to go to the discussion of the day, which is actually the end year adjustment. We are supposed to cover, I think 4 areas. We are supposed to cover the accruals, the prepayments, bad debts, and the depreciation. I'm so sure time will not allow, but let's see how far we shall go. I want to share the PowerPoint presentation for that particular topic. So we have here the accruals and prepayments. I will take you back a bit to the accounting principles and concepts that we discussed. And we said accounting principles and concepts are actually the rules or regulations that have been agreed globally on how accounting should be conducted in organizations, so that actually we can have some kind of uniformity. And under those concepts, we discuss about the matching concept, which is also known as the accrual concept. And this concept simply states that revenues and expenses, they should be captured in the financial year where they were incurred and not the year when the amount is paid or received. That is to say, a business being a going concern enterprise, it is going to be operating from one financial year to the next, to the next, to the next. So we are going to have a chain of so many financial years, so many of them. And more often, you'll find that some transactions have spilled over. Like, for example, it is a salary that was supposed to be received this financial year. You find that it has been paid in the next financial year. Now a question will arise, where will we put that amount of money which was incurred in a particular financial year but was paid in the other financial year? I want to be very specific. Let me pick 2 years. Maybe we are talking about 2019 and the year 2020. The salaries for December 2019, many organizations will pay them in January 2020. If the financial year of that particular organization runs from 1st January to 31st December, so the salaries for December 2019, they were paid in January 2020, and those two are two different financial years. The financial year for 2019 ended 31st December 2019. The financial year for 2020 started 1st January 2020. Now, the amount of money for salaries for 2019 has been paid in 2020. So somebody might ask a question, should I place it in 2020, which is the year I have paid, or should I place it in the year 2019, which is the year the amount was incurred? The correct position should be the amount should be entered in the year 2019 because that expense was for 2019 and not for 2020. So accrual here, it simply states that the amount of money either earned or incurred, they should be put or they should be matched with the accounting year they were incurred and not when money is being paid. So when we are coming to the end of 2019, if we had paid up to the month of November and we have not paid December, we should also add the salary for December, even if it has not been paid. Even if it has not been paid, we should add it so that now we can get the total salary expense for that whole year from January up to December 31st. If we do contrary and we write that particular amount of salary that was paid in 2020, though it is for 2019, then the year 2019, it is going to have less salary expense amount, which is not correct. Expenses, they should all be entered in the financial year they were incurred. Also revenues, they should be entered in the financial year they were earned. Whether they have been received or not, you just add them there. That is actually what we mean by accrual. If I go to prepayments, you can have another scenario. A business might pay an expense before the actual time for paying has come. That is to say, we have paid for an expense before actually we are asked to pay. Like if, for example, it is an insurance expense, and we normally pay maybe 1,000 per month. So for the whole year, we are supposed to pay 12,000. A business might decide to pay maybe 15,000. Note the insurance expense for one financial year, because we are paying 1,000 per month, it is supposed to be 1,000 for the 12 months, which is 12,000. But if the business organization has paid 15,000, then it simply means that we have paid 3,000 excess, which is going to be utilized in the next financial year. The 3,000 which were paid in this financial year but will be used in the next financial year, that amount of money is normally said to be prepaid. That amount is normally said to be prepaid. Even if we paid 15,000 and the correct amount for this year is 12,000. So it is going to be correct only if we capture 12,000 as the insurance expense for that particular financial year. We should not make a mistake and record 15,000 because the whole 15,000 was not for that particular financial year. From those two statements, I want to summarize this. The accruals, when we have the accruals, accrual simply means that money has been either an expense or actual revenue. Let me talk about expense first. Either an expense has not been paid or a revenue has not been received. That is what we mean by accrual. But the financial year has come to an end, but we have not paid a certain expense or we have not received a certain income. If it is an expense, we normally call it accrued expense. If it is a revenue that we have not received, it's normally called accrued revenue. So in accounting, that accrued amount is normally added. So if, for example, it is salaries, up to January, up to December, January to November, we had paid 110,000. And the expense is supposed to be 10,000. So we need to add the 10,000 for December, which has not been paid, which is actually accrued. So accrued we normally add so that we can get the total expense for that year or the total revenue for that year, including that amount which has not been paid. For prepayments, we normally subtract. If you had paid 15,000, but the expense is 12,000, so we normally do 15,000 minus 12,000, the 3,000 is the prepaid. So from onset, I want you to have it on your mind that accrued amounts are normally added to the revenue or expense item, whereas prepaid, they are normally subtracted. So if it was 15,000, but the correct amount is 12,000, we subtract the 3,000. So that is what I want you to understand from the onset as we go deeper into the discussion. Then,
one repeat.
I repeat, let me go back. I won't mind to repeat.
Thank you.
Okay. I was talking about the accrued, and I gave a simple example. If, for example, from each and every month, let me talk about salary. Each and every month, we normally pay 10,000 to our employees. So from January up to November, which is actually the month that we have paid all the salaries, so it's going to be 10,000 times 11 months. So we have paid 110,000. But the salary for December, which is the last month of the year, maybe it's going to be paid the following year in January. When we are ending the year as at 31st January 2019, the salaries that we have paid, it is 110,000, but there is a salary of 10,000 that we have not paid. For us to be able to get the salary expense for the whole year, it is 110,000 which has been paid plus the 10,000 which is accrued. So the whole year salary was supposed to be 120,000. So accrued expense or accrued revenue, you normally add. So accrued simply means the amount that has not been paid or the amount that has not been received. For expense, it is an amount that we have not paid. For revenue, it is an amount that we have not received. So we normally add that amount so that we can get the total amount either we were supposed to pay if it is an expense or the total amount that we are supposed to receive if it is a revenue. Musangi, have I communicated?
I've had expense, but not issues. If not yours, mine.
So come again. I don't know why you are breaking. Come again, please.
I'm saying,
yes,
I've gotten the one that is normally added. That is the accrued expenses.
Okay, let me explain the prepaid.
Mm-hmm.
The prepaid, it simply means that you have paid in excess. So if, for example, we normally pay an insurance amount of 1,000 per month, for the whole year, we are supposed to pay 1,000 times 12 months. So we are supposed to pay 12,000. But you find maybe the business for that year, it had paid insurance worth 15,000. So you will be able to realize here that there is 3,000 that has been paid in excess. The amount that was expected was 12,000, but we have paid 15,000. So the 3,000, it is normally the amount we normally refer as what? Prepaid. So the prepaid amount, it is not for this year. The 3,000, we are going to use it next year. It is going to be prudent if now January, February, and March of the next year, we don't pay any insurance, so that the amount that we had prepaid can take care of that. So if we are looking for the insurance expense for that year, it is going to be 15,000, which we paid. Then we minus 3,000, which is actually prepaid, so that we can have 12,000, which is actually the insurance expense for this year. So anytime we witness a prepayment, we normally minus the prepaid amount so that we can get the actual amount for that year. That is what I meant.
Thank you.
Karibu sana. Okay, let me now maybe brush through the next slides, which is on accrued expenses. Accrued expenses are expenses which have not been paid, but the financial year has come to an end. Like the example that I've been giving here of salary. If the year has come to an end and the expense has not been paid, that amount that has not been paid, the amount that has not been paid only is known as the accrued. So it can be accrued salary, it can be accrued insurance, it can be accrued electricity, so long as it has not been paid, but the financial year has come to an end. Then we have accrued income. Accrued income, it is an income that has not been received, but the financial year has actually come to an end. Like remember the question that we were talking about, the errors, where we were talking about rent receivable. Rent received, it is an income. If the year has come to an end and there is one tenant who has not paid us, the amount the tenant has not paid us, that amount we consider it as an accrued income, because it was supposed to be received in that financial year, but it has not been received. Then we have the prepaid expenses. These are expenses that have been paid actually in advance. The other term that we normally use here is advance. Then if we have paid upfront, like even in your school fees scenario, if you have paid school fees in excess, that you have paid in excess becomes the prepaid, and you are going to utilize it next year. So when you come to next semester, maybe your school fees is going to be reduced by the amount of money that you had prepaid in the previous semester. So prepaid expense, it is an expense which has been paid in excess, or it has been paid before the time for payment has come. The prepaid income, it is an income that we have received before the actual time of receiving. So for the rent receivable example, if there is one tenant who has maybe paid 3 months upfront, and the 3 months happens to be for the next financial year, the 3 months now, that amount of money is going to be a prepaid income. It is an income that we have received, but the time for receiving has not come. The time for receiving has not come. So that is actually the part of prepaid and accrued. But I want to go back a bit so that I can explain something here, because you have it in your notes. So far, we have talked about assets and liabilities. And we have said that assets are the resources that belong to the business, whereas liabilities are the resources that are in the business that are supposed to be paid to those who had given us, or to those from whom we had borrowed from. So the accrued expenses and accrued income, one of them, it is a liability, and one of them, it is an asset. Anybody to try? Accrued expense and accrued income. One of them is an asset, One of them is a liability. An asset is what belongs to you. A liability is what belongs to the other person. What do you think between accrued expenses and accrued income? What is a liability and what is an expense? Sorry, what is a liability and what is an asset?
Accrued income is an asset, while the accrued expense is a liability.
Exactly. Accrued expense is a liability because liability is like a debt. So if you have accrued expense, it's like you are having a debt. If you have not paid your employees, that is a debt to those employees. That is a liability. Whereas accrued income, it is money that you are supposed to receive, but you have not received. So it is an asset to you. It is your money. So thank you very much. But when we shall go into the financial statement, accrued expenses, it's actually a short-term liability or a current liability. Accrued income, it is a short-term asset or a current asset for that case. When we go to the next category, which is the prepayments, prepaid expense and prepaid income. One of them, again, is an asset. The other one is a liability. So which one do you think is a liability and which one do you think is an asset to the business? To guide you, an asset is what the business owns, what belongs to the business. A liability is a debt. It is supposed to be paid back. Prepaid expense, prepaid income. Allow me to assist you. A prepaid expense, it is an asset. A prepaid expense, because we have paid in excess. So there is, in this case, we paid 15,000 instead of 12,000. So we paid 3,000 excess. This 3,000 in excess, it is still our money. We have not actually received any services. It is still our money as the business. So this is an asset to the business. But prepaid income, you have received income from a particular person before the time for receiving has come. So if, for example, I'm paying maybe Susan rent. If I pay the rent for December right now, it is like Susan has got my rent, or I don't know how I'm going to put it. That is still, to Susan, it's like a debt, because I can decide and say, maybe Susan, can you give me that rent first? I sort out some things, and then I'm going to give you when December comes. So it's like you owe money to that particular person who has paid you before the date for payment has come. So prepaid income, you have received money from somebody, but the time for receiving it has not come. So you need to note that. So I was explaining that part of prepaid income and prepaid expenses. A prepaid expense, you have paid, but you have not received the services. So you can demand that money. A prepaid income, somebody has paid you before the time for receiving that money has come. So those are the explanations for accruals and prepayments. We are going to see how we treat it in our next chapter, which is now the financial statements of a sole trader. We are going to see how we make those adjustments, and then we extract the financial statements for the year end. The next discussion we are going to talk about is bad and doubtful debts. Bad and doubtful debt. Any business that engages in credit sales, any business that engage in credit sales, it is going to create people we call debtors. Debtors are those customers who buy goods from the business on credit terms. Not all the customers are going to honor their accounts. when the time falls due. Some debtors may fail to pay the business the amount they are supposed to pay. So here, those debts that we have confirmed that they are not going to be recoverable from our customers who are debtors, those debts are normally considered as bad debts. So a bad debt, it is a debt that the business has confirmed to be unrecoverable. Either the customer is bankrupt, either the customer died, or whichever the reason that you have confirmed, the customer will never pay you. Once you confirm it, then that debt becomes a bad debt. The debt becomes a bad debt. Then we have got debts we call doubtful. Doubtful debts are those debts that actually we are not so sure. They might be paid or they might not be paid. Therefore, they are considered as doubtful. So note the difference, bad and doubtful. Bad, you have confirmed. Doubtful, you are not sure. In accounting, we normally have what we call, let me not leave this first. We normally have what we call provision for doubtful debts. If you are dealing with the debtors, which are actually credit customers, if you are dealing with them, it is going to be very prudent for you to make a provision. A provision here, it is an estimate. The business being a going concern, and you have done it for quite a number of years, you can be able to predict from the previous financial years. As a business, we normally witness a case whereby maybe 25,000 of the debtors, they don't pay. So what you need to do, you need to become prudent and say, therefore, this financial year that is starting January 1st, 2020, we have a provision. A provision is money set aside. We set aside 25,000, which will cater for a scenario where some debtors are not going to pay. So if we set an estimated amount aside at the beginning, remember this is at the beginning of the financial year, we set this 25,000, it is going to cater for those debtors who might not pay this whole financial year. So you have made a provision for doubtful debts, which you are not sure, you are just doubting they might not be paid. Once you run the year up to the year end, that is 31st December, you are going to confirm. At the beginning, you are estimating. At the end, you are confirming. At the beginning, you estimated that 25,000 might not be paid by the debtors. At the end, you confirm how much are we not going to receive from the debtors. Maybe you find it is above 25,000 that you had approximated or below the 25,000. Now the question is going to be, how do we treat this provision? If you had estimated 25,000 is not going to be paid, and you find that maybe 26,000 is not going to be received, what do? There is only an increase of 1,000. The provision was 25, you have confirmed 26,000 is not going to be received. So the provision is, or the actual is above the provision by only 1,000. The 1,000, which is actually referred as increase in provision for doubtful debt, is normally considered as an expense in the income statement. As we are recording or trying to calculate the net profit, the 1,000, which is the increase from the estimated amount, is normally captured as an expense. As we are writing the insurance expense, repairs expense, stationery expense, we need also to capture increase in provision for doubtful debt, 1,000. You only capture the 1,000 only, not the whole 26,000. The increase only. If you run the year up to the year end and then you confirm the provision was 25,000, but you confirm that maybe 22,000 is what we are doubting to be payable. We had estimated 25, but we confirm maybe 22,000 is what is doubtful. So you realize that you had estimated a higher amount than the actual that has been confirmed. So 25,000 minus 22, it is going to be a decrease in provision. It has decreased from what you had provided. Therefore, the 3,000, which is a decrease from what you had estimated, is normally considered as an income to the business, and it is normally added to the gross profit. It is normally added to the gross profit at the year end. Don't know whether it is clear. At the beginning, we make the provision. At the end, we confirm. Once you confirm, either it is an increase or a decrease. Increase, put as an expense. If it happens to be a decrease, you add it to the gross profit as you move along. I know maybe you might be wondering how we do it, but I want you to have it. Once we go to the next area, it is going to be very easy for you to remember what I've just said. Having said that, the last bit that we need to do is on depreciation. Depreciation. Depreciation is defined as the loss in value of fixed assets. Fixed assets, once we acquire them, the amount that we spend on them is not considered as an expense in the business. It is never considered as an expense in the business, because an expense, it is an amount that actually or a service that we have incurred, and the whole amount has been utilized once in that particular financial year. But for a fixed asset, remember, it is supposed to remain useful in the business for a period exceeding one financial year. It should be in the business for maybe 3 years. So if we buy like a motor vehicle, maybe 2 million, we cannot take it and consider it as an expense for this financial year, because it is also going to be next in the business the following year, and the other year, and the other year. So what we normally do, we normally charge or spread the cost to all the years. If it is a motor vehicle and is going to be in the business for 5 years, so this cost of 2 million should be shared by the 5 years that particular motor vehicle or fixed asset is going to be in use in the business. Like, for example, let me come here very clear. Maybe we have bought a furniture worth 50,000, and it is going to be used for 5 years. It is going to be very reasonable to charge 10,000 for year 1, 10,000 for year 2, 10,000 for year 3, 10,000 for year 4, 10,000 for year 5, so that each and every year the furniture will be in use. That year also shoulders a portion of its cost, so that it is not a burden for 1 year only, yet it is going to be used in the other subsequent financial years. The charges that we normally make in the financial statements, it is in form of depreciation. It is in form of depreciation. It will simply mean that I've bought that furniture 50,000. Year 1, I use it, and then it loses 10,000. So I charge 10,000 as a depreciation expense for this year. The next year, it is used again, then it loses 10,000 in terms of value. So we charge 10,000 for that year. The next year, it is used, it loses 10,000. So we charge it like that, so that by the end of year 5, this asset has reduced its value to 0, and therefore it does not have any value to be used in the 6th year. So you find that the 50,000 has equitably been shared by the 4 or the 5 years the furniture has been useful to the business. So that was another story. But now, what is depreciation? Depreciation, it is that portion of the value of the asset that is lost as a result of that asset being used in the business. As you use that motor vehicle, it is losing the value. As you use that machinery, it is losing the value. As you use that computer, it is losing the value. That loss is what we normally charge as depreciation. It's referred as a depreciation. Then here, we have got what causes depreciation. Number one, we have got the physical factors. We have the main cause, it is wear and tear. As you are using the fixed asset, it suffers wear and tear. Some fixed assets, they decay, especially the wooden, like the furniture, if they are not properly kept, and maybe they are kept in a place that is raining and all that, they decay. They last, some of them, especially the motor vehicles, if they are not properly kept, they rust, and we have erosion, something like land, it can suffer erosion, and as a result of all this, its value is being lost. Then we have economic factors. Economic factors, number one, we have obsolescence, or an item becoming obsolete. This is as a result of technology, whereby new models are coming into the market. As new models come into the market, the model that you have in the business becomes outdated. And as it is becoming outdated, its value is reducing. Think of a scenario whereby maybe some years back we were using the typewriter, but now because of technology, you find that the typewriter has been rendered obsolete and its value will reduce drastically. Then we also have another cause, which is inadequacy. Inadequacy, it is maybe as a result of expansion of the business organization. As the business is expanding its activities, the assets which it has or it had will be inadequate. They will not be enough. Maybe we were having one computer, we don't need a computer or a single computer anymore. We were having a very small pickup. We need a very big lorry right now and things like that. As a result of that, that small pickup now becomes like it is not useful, and we can normally say that its value is reducing as a result of being inadequate in the business. We also have the time factors and the depletion. Depletion here, it works best in minerals. If, for example, we had the minerals, as we are using those minerals, we are depleting them, and things like that. Basically, those are the causes of depreciation. Methods of calculating depreciation, we have got two main methods. That is the straight line method and the reducing balance method. And I want to share the screen so that I can show you how we calculate depreciation using those two methods, or even the others, because we are going to use those calculations in our next chapter. Methods of calculating depreciation. So, the topic here is on depreciation, and I want to focus on the methods. Methods of calculating. The first one we have is called the straight line. Sorry. The straight line method. So, the straight line method, it is a method of calculating depreciation where we assume the cost of that particular asset is going to be shared equally in all the years it is going to be useful in the business organization. If, for example, I buy a computer, maybe its value is, our cost is 20,000, and will be used for 5 years. And after being used for 5 years, its value will be 0. We cannot use it anymore. You will find that now depreciation will simply be calculated by the cost, which is 20,000, and we divide by 5 years, which is the number of years it's going to be useful. And then we find that it's going to be reducing 4,000 per annum. So each and every year we use, it loses 4,000, 4,000, 4,000, such that by the time we go to year 5, the end of year 5, it does not have any value. So the straight line method, it is simply going to allocate depreciation equitably to all the years the asset is going to be in use. So in some cases, a fixed asset might not have a zero value at the end of its useful life. Like for example, if I have that computer, you can find a case whereby after year 5, I can sell that computer and maybe I recover 2,000 from it. This 2,000, it is normally referred as the scrap or salvage value. I bought it at 20,000. I'm going to use it for 5 years. After the 5th year, this computer can be sold at a throwaway price and I get 2,000 from it. The 2,000 is what I'm referring here as the scrap or the salvage value. In this case, depreciation is normally calculated by the cost we minus scrap or salvage value, and then I divide by useful life. Useful life or the economic life. So in this case, depreciation per year will be 20,000, which is the cost, minus 2,000, which is the scrap value, over 5 years, which is the useful life. And then I would be able to get the depreciation per year, which would be actually 18,000 over 5. And the value here, remember, I'm getting it is per year, per annum. So this is actually the method or the formula for calculating depreciation under the straight line method. It is the cost minus the scrap or salvage value over the useful life or the economic life of that particular asset. You get your depreciation per year. Sometimes the straight line method, you can be given in percentage. You can be told it is the asset depreciates at 20%. If you are given on percentage basis, you will be told 20% on cost. You will be told it's going to be 20% on cost. So like here, you are told it is 20%, you just calculate 20% times 20,000. So you get that and you find it is 4,000 maybe. You know? So if you are told to calculate when you are given a statement, you use the formula cost minus scrap value over useful life. If there is scrap value, you put it there. If it is not there, you put it 0, and then you divide it by your useful life. If you are given the percentage, it is 20% of the cost. The cost, remember, it is the price that was paid to acquire that fixed asset. Another very common method for calculating depreciation, it is known as the reducing balance. But in some books, you will find them referring as diminishing. Diminishing balance. Diminishing balance method of calculating depreciation. It is actually like the opposite of the straight line method. With this method, it assumes that when an asset is new in the business, it is used more. When it is new, it is more used, and therefore it depreciates more. So as it is being moved from one financial year to the next, you find that it is less and less being used, and therefore depreciation also reduces. So this method proposes that a new fixed asset will be more used, and therefore it will depreciate more. And as the years go by, its usage is less, and therefore its depreciation. So if you are given an illustration like this, a company bought a motor vehicle worth 1 million. A company bought a motor vehicle worth 1 million. 1 million, let us put as full stop and say it depreciates. It depreciates its fixed assets at 10% per annum on reducing balance basis. Now the question is, calculate depreciation amount, for the first 4 years of these motor vehicles. So you have been told clear here, the company depreciates its fixed assets on a reducing balance basis. If it is on reducing balance basis, this is how we normally do it. You have here, this is year 1. We have been told we calculate depreciation for the first 4 years. So we can have depreciation here. We calculate depreciation here. And then we can have what we call the net book value. The net book value. Net book value, it's normally calculated by cost minus accumulated depreciation. So for year 1, because it is the first year this motor vehicle is being used, the depreciation will be 10% times 1 million. 10% times 1 million, it is going to be 100,000. That is the depreciation for year 1. Remember, this motor vehicle had a cost of 1 million. If we minus the depreciation for year 1, which is 100,000, what will be the book value for this asset by the end of year 1? Tulinunua 1 million, imerus 100,000. So the book value will be 900,000. Thank you. 900,000 will be the book value by the end of year 1. Remember, tukianza nayo, it was 1 million in value. It has lost 100,000 in the course of the year. So at the end of the year, its value will be 900,000. So when we go to year 2, depreciation will be 10% times 900,000. The net book value as we are starting. Remember, the end of year 1 is the same as the beginning of year 2. So the year ends 31st December, the next year starts 1st December. So the value here, it is what now going to be the basis of calculation of depreciation. And you find here, it is going to be 90,000. So what would be the net book value of this asset at the end of year 2? It is going to be 1 million minus the sum of 2 depreciation. So it is 1 million that we started with minus depreciation for year 1 and 2. So value yake itakuwa ngapi? Yes?
810.
810,000. So when we go to year 3, what will be depreciation? 10% times 810,000. So that you get here, it's going to be 81,000. So the net book value will be 1 million minus 100,000 plus 90,000 plus 81,000. You get the book value at the end of year 3. So the book value, it is 1 million minus the depreciation for year 1, year 2, and year 3. You get how much? Somebody to subtract for me. Yes. 1 million minus 90 minus 100 plus 90
721.
plus 721.
29.
729,000. 729,000. So when we go to year 4, the depreciation will be 10%, sorry, times 729,000. You get this one is going to be 72,900. So you get the net book value here. It is going to be 1 million minus 100K plus 99, like that, like that. That is how we do the reducing balance method. And you'll be able to realize the depreciation for year one was 100,000. For year two, it has reduced to 90,000. For year three, it has reduced to 81. For year four, it has reduced to 72,000. And that's why it is known as the reducing balance method. So it reduces because the net book value keeps reducing. As we are using the asset, the net book value is reducing, and we are calculating depreciation on the basis of the net book value. If the net book value has reduced, obviously the depreciation will reduce like that, but the depreciation percentage remains constant. That is how we calculate depreciation using reducing balance method. So anytime you are given a question, your work will be, how is depreciation calculated? If you are told depreciation is 10% on the net book value, then the question is simply telling you to use the reducing balance method. So the reducing balance method, depreciation is calculated on the basis of net book value. And how do you get the net book value? It is the cost minus accumulated depreciation. Accumulated depreciation here, it is the total depreciation from the date of acquisition up to the last day of the financial year, of the previous financial year. From the date of acquisition up to the last day of the previous financial year. The total depreciation you minus from the cost so that you get the net book value. Once you have the net book value, you now multiply by the percentage of depreciation and you get your depreciation for that particular financial year. The depreciation that you have obtained for that particular financial year, you add it now to the depreciation for the previous year. So the depreciation goes on increasing here as the net book value is reducing. So that is how we do depreciation for that. Having said that, I want to brush through the other methods. You might be, they are not very common in exams, maybe in the preparation of financial statements, but some cases you can be given a question of maybe 4 marks for you to be told to calculate depreciation using a certain method. We have other methods. Number one, we have the sum of years method. We have the sum of years method. So you can be given, let me do it using this example. You can be told maybe we bought a computer of shillings 25,000. Economic life or the useful life is maybe 5 years. Now you are told, can you calculate the depreciation per year using the sum of years, sometimes known as the sum of digits method? So what you need to do here, you need to add these years. You add it like this. Come here and you say sum of years will be equal to 5 plus 4 plus 3 plus 2 plus 1. You add from this year, you go reducing by 1 up to go to 1. So what will be this sum? This is 9 plus 6. This one will be 15. So the sum of the years will be 15. So depreciation for year 1 will be, when we are starting the year, remember there are 5 years that are remaining. This computer is supposed to serve us for 5 years. At the beginning of the first year, it simply means that this computer has got 5 years to take us. So it is going to be 5 over the sum of the years times the cost, which is 25,000. You get the depreciation for year 1. When you proceed to year 2, see already 1 year has gone. Already 1 year has gone. If 1 year has gone, then the remaining number of years is 4. You put 4 over 15 times 25,000. You get the depreciation there. When you go to year 3, how many years are remaining? Already we have year 1 and year 2 gone. So 3 years are remaining over the sum of the years. Then you multiply by the cost, 25,000. You get that. Year 4, 2 years will be remaining. out of the sum of the years times 25,000. Then year 5, only 1 year is remaining out of the 15 times 25,000. So that is how you get depreciation for each and every year for those 5 years. So first of all, you add, if you are told it is 7 years, then you need to start with 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1. You need to get the sum of the years first, and then now you start with this highest over the sum times the cost of that, as you get the depreciation for each and every year. I feel like stopping there.
Yes, Mwalimu.
I feel like I should stop there, so that when we meet next week on Monday, we finish on depreciation. We need, there's somewhere we need to do some calculation on depreciation and prepare the assets accounts. These assets that we are talking about that are depreciating. Sometimes they are depreciating and they are sold by the business organization. We need to prepare those accounts, which I don't want to do today. Let me do it on Monday. And then I hope we shall finish. Yes. Nene.
Yeah, Mwalimu, who determines the number of years an asset's, the useful life of an asset?
From the industry point of view or from the examination?
You see, when from an industry point of view,
yes,
when you buy a vehicle and decide that the useful life is 5 years,
yes,
and we know in practice,
yes, you
can use that vehicle for up to 10 years comfortably. So who determines what you put in the?
Okay. Let me respond. What normally happens is this: in a big organization, we have the cost accountant or the management accountant and people like that. And when they are fixing the economic life or the useful life of an asset, they normally do it from experience, such that they know if we buy a vehicle, it normally takes us maybe 4 years, and then it starts bringing us trouble. And at that point, we can sell it because maybe the cost of repairing it every now and then is very high. So it is normally through the experience that the organization has learned, and now they can be able to fix the economic life of that particular asset. I don't know whether I have answered you, Nene.
Yes, you have answered. But what if it's a new machine in the market? There is no experience as to how long it can be used.
Okay, so you mean maybe it is a new model that has come into the market?
Yes.
Into the market. Now here,
yes.
The organization now will have to do some feasibility study. Either from the organizations who have maybe acquired it earlier alone, and maybe they have seen how it is serving them, and then now they compare. Maybe that organization is of equivalent to that particular organization, and then they can be able to compare and say, maybe if this organization used this equipment or machinery for this number of years, and our production is more or less the same as theirs, also our organization is going maybe to use this organization for the similar number of years. If maybe their production scale is a bit higher, then they can decide to bring their economic life maybe slightly lower or something like that.
Okay.
Yes.
And then in these other methods, the net book value.
Yes.
So the reducing balance.
Yes.
The reducing balance method, does it have the scrap or salvage value?
No, it does not have.
It's only the
you just depreciate it until when you find that it is going to be zero itself. Okay. If, for example, it was to be used for maybe 4 years, you realize you calculate depreciation up to the 4th year, you leave it at that point. But if it was continuous, you just go on, the value will keep on reducing until it will just be zero itself. That is when.
Okay.
Yes.
So when you sell the item, you don't put it back as the salvage value?
When you sell it, That is actually now where we shall be going on Monday, when we have what we call disposal. You acquire a furniture, you don't wait it until it is having a zero salvage value. Somewhere you sell it, you are going to have the disposal. We are going to prepare the disposal, and then you are going either to get the loss on disposal or the profit on disposal. That is going to be done on Monday in this class.
Okay, thank you.
Can we end the class at that point?
Yes, Marilyn.
Yes. Let us end it at that point so that we can be able to digest what we have talked today. Otherwise, thank you very much. Let me wish.
Marlene, you had recorded.
Yes, I had recorded.
You may send to us. Some of us were losing. We were on the road.
Okay. I'll just share it in a while. Actually, I'm going to share it before I leave the office.
Okay, thank you.
Okay, Karibu.
And kindly open the Nini for me to submit the assignment.
Okay. Let me do it. Yeah.
Okay, thanks.
Have a blessed evening and a very fruitful week.
Thank you.
You too.
Yeah.
Thank you.
Thank you.